Hi everyone, welcome back to our monthly economic update. I'm John Cleaver, CEO and Private Wealth Advisor, and I'm joined today by Kelley Manning, Financial Advisor. Thanks for being here, Kelley.
Thanks, John. I'm happy to be here.
You know, as always, our goal is to help bring perspective to what's happening in the markets and the economy, hopefully remove a little of the emotion that headlines can create. And Kelley, this month definitely brought plenty of headlines.
It sure did. Oil prices, geopolitical tension, inflation concerns, questions about interest rates. It's been one of those stretches where investors start to feel like everything is happening at once.
You know, and honestly, that's pretty normal during uncertain periods. Markets rarely move in a straight line, and emotionally, it can feel heavier when those headlines start stacking on top of each other. But one thing we've been talking about internally is the difference between the volatility we're experiencing and a true deterioration in the market. Those are not always the same thing.
No, they're not. And right now, markets are reacting to inflation concerns tied to higher energy prices and geopolitical tension. But we're not necessarily seeing evidence of a broad economic breakdown underneath the surface. And that is an important distinction.
Yeah, and I think investors immediately jump to recession fears anytime oil spikes or inflation starts moving higher again. But so far, this feels more like a repricing environment than a true growth scare.
I would absolutely agree with that one. One encouraging factor is that consumers are actually spending a smaller percentage of their income on energy today than during many past periods of economic stress. So while higher oil prices absolutely matter, households generally have more cushion than they did historically. And importantly, we're still not seeing widespread demand destruction, meaning consumers dramatically pulling back spending or businesses sharply slowing activity.
Yeah, that's a really key point because markets often react first and then try to determine later where the economic damage is actually material. And right now, we continue seeing a relatively resilient economy underneath the volatility.
Well, one thing that's interesting right now is that the economic growth may actually be broadening a bit. For a while, it felt like only a handful of mega cap tech companies were driving everything. But we're beginning to see improvement in industrial activity and infrastructure-related areas too.
You know, and that's honestly healthier for the long term. Narrow leadership can work for a period of time, but a broader participation tends to create more doable markets. And I think that's important because many investors start assuming volatility means everything is broken. Sometimes markets are just recalibrating expectations while the economy continues moving forward.
Exactly. Volatility can actually be part of a healthy market process. It forces repricing, it resets expectation, and it often creates opportunities underneath the surface.
Now, obviously, interest rates remain a huge piece of this conversation. Earlier this year, the narrative was all about aggressive rate cuts and coming fast. Now expectations have shifted again toward higher for longer.
Yes, and that shift really came from inflation concerns reaccelerating somewhat because of energy prices and continued economic resilience. The economy simply hasn't weakened enough yet to force the Fed's hand aggressively lower.
Yeah, and this is where investors can sometimes get themselves in troubles, trying to perfectly predict every Fed meeting and every Fed decision.
Right, because expectations change constantly. One inflation report changes sentiment. One jobs report changes sentiment. One geopolitical event changes sentiment.
Yeah, which is why we spend much more time focusing on whether a client's plan can survive these different environments rather than trying to perfectly forecast every short-term move. Because nobody consistently predicts these things with exact precision.
No, but one area that still remains really constructive long-term is productivity and technology adoption. There's growing evidence that we may be entering another meaningful productivity cycle tied to AI and automation.
You know, and historically, these periods matter enormously over time. You think about the internet boom, PC adoption, smartphones, there's always volatility during those transitions, but productivity gains eventually reshape the economy.
Yes. Businesses are increasingly adopting tools that improve efficiency, lower cost, and streamline operations. That doesn't mean every AI company succeeds or that the market moves straight up from here, but structurally, those productivity improvements tend to support long-term growth.
Yeah, and that's where long-term perspective becomes so important. Innovation almost never unfolds smoothly. There's always periods of hype, pullbacks, resets, uncertainty. But over decades, productivity and innovation have historically created tremendous value. You know, another thing we've been discussing with clients lately is the difference between the stress from the market and the systemic risk, because there's definitely stress showing up in certain areas of certain markets.
Absolutely. Higher rates always expose weaker areas of the market. But broadly speaking, we still aren't seeing the type of excessive leverage buildup that typically exists before major financial crises.
Yeah, that's a really important distinction. Some companies and sectors will absolutely struggle in a higher rate environment. That's normal. But overall, corporate balance sheets are healthier than many previous cycles, as evidenced by recent earnings.
Which makes it feel more like repricing and separation environment. Stronger companies versus weaker companies, rather than a broad systematic instability. John, one thing I think clients really need to hear right now is that uncertainty itself is not unusual. Sometimes it feels like markets are supposed to feel calm all the time, but historically, they rarely do.
You nailed it, Kelley. The reality is there will always be something to worry about. Inflation, elections, geopolitics, recession fears, interest rates. The headlines change, but uncertainty itself is permanent. And that's why successful investing is less about reacting emotionally to every headline and more about building a disciplined plan that can weather different environments over time.
And honestly, that's where planning creates confidence. When clients understand their strategy, their time horizon, their long-term goals, short-term volatility becomes easier to navigate.
You know, at Beyond Wealth Advisors, we continue to believe that clarity creates confidence. And with confidence, it allows families to make wise long-term decisions instead of emotional short-term reactions. Because ultimately, wealth is not just about markets or returns. It's about helping families create flexibility, opportunity, and long-term significance across generations. If recent volatility has raised questions around your portfolio, retirement plan, taxes, or even your long-term strategy, you know, we'd love to have that conversation with you.
Absolutely. So that's it for us today. Thank you so much for joining us.
Yes, and we appreciate you being here, and we will see you next month.